Hi, this is Bill Berkman. Welcome to a reflection for my Gov Money News website. Today, I'm going to have a little thought or two about inflation. And we've been hearing that inflation is falling. Should we all be breathing easier now? Let's think about this a little bit. Here's a look at the CPI inflation rate since 2016. In front of you now, you've got the chart, the CPI year-over-year percentage change. You can see what freaked a lot of people out and should have in 2021, 2022, and really sharp, significant increase in the CPI inflation rate, which over the last year or so has now come down after peaking at roughly 9% in 2022. The CPI inflation rate has come down to a smidgen over 3%. Is this, should we all breathe easier now, or is this still worthy of concern? And I believe the latter. We haven't really whipped inflation now. You got to remember, the CPI, first of all, is a long story why it's not necessarily a perfect indicator of the price level in the United States. But the CPI inflation rate is the year-over-year percentage change in prices. And if inflation, according to this measure, is, quote, falling, we're talking about a price level that's still increasing, just at a lower rate. So we haven't exactly whipped inflation now if this is still positive. Not only that, if we look back a little bit further, it's not so comforting, it's not so comfortable. We're still going up from really high levels in a year ago. If we take a longer perspective, say if we look over the last 3 years, here's what the picture looks like. The CPI inflation rate, again, a year-over-year percentage change on average over the last 3 years. You've got a number that's has not gone up more, but what this is it's not accelerating anymore, at least in the last 6 months. It's still a significant rate of inflation from a longer term perspective. That's not exactly a longer term perspective. Let's take a look at another longer term perspective. And that's to, let's do this now. I'm going to stop sharing and share another slide. Here's a look at the CPI, not the inflation rate, but the consumer price index. So we're not looking at the year-over-year percentage change or the rate of change in the price level. We're looking at the price level as measured by the consumer price index, which itself, again, is not necessarily the truth. But let's see what it says. And that's, going back to World War II in 1950, you can see the pointer. We're going up a little bit, and then things start accelerating in the 70s. And here we are in 1977, and after the acceleration in the 60s and the 70s, Congress passed a law giving the Federal Reserve its current mandate for monetary policy and directed it to pursue the goals of stable prices, maximum employment, and moderate long-term interest rates. Those three goals, stable prices is not a stable rate of inflation. It's a stable prices. Okay, since Congress passed this law calling for stable prices, how stable have prices been since 1977? If they were stable, strictly speaking, and it's possible falling prices slowly aren't bad for you either. But if they were stable, well, back in the 70s, in the 1977, the year that Congress passed that Federal Reserve Reform Act, we've gone from 62 on the CPI. We're not going sideways. We're still going up and up and up, and then significantly up in the last few years. It doesn't look like we've whipped inflation now, according to this measure, and it raises questions fundamentally about the oversight of the Congress and whether or not, the rule of law is really operating. That's my opinion. In recent weeks, we've had some senators, including Senators Paul and Grassley, introduce and reintroduce a revised version of a new audit bill for the Federal Reserve. And maybe that's one way to start thinking about this a little more carefully. It'd be nice to see that law passed. Thanks for listening, and my name's Bill Bergman. Have a nice day.